The US-China trade war erupted in 2018. It was sparked by the Trump administration's decision to impose tariffs on Chinese goods. This move was part of a broader strategy to address what the US perceived as China's unfair trade practices, including intellectual property theft and forced technology transfers. The stated goals were ambitious, aiming to reduce the US trade deficit with China and protect American industries from what the US saw as unfair competition. The administration believed that these tariffs would pressure China into making significant economic reforms. However, the tariffs ignited a chain reaction, leading to retaliatory tariffs from China and a tit-for-tat escalation that has continued for years. Each side imposed increasingly severe tariffs, affecting a wide array of goods and industries. By 2025, the trade war has reached a fever pitch. The economic conflict has intensified, with both nations digging in their heels and showing no signs of backing down. Tariffs on hundreds of billions of dollars worth of goods are in place. These tariffs have created significant barriers to trade, complicating the flow of goods between the two largest economies in the world. The tariffs impact a vast range of products, from consumer electronics to agricultural goods. Everyday items, from smartphones to soybeans, have seen price hikes affecting both producers and consumers. The initial volley of tariffs has morphed into a complex web of trade barriers, impacting businesses and consumers on both sides of the Pacific. Companies have had to navigate this new landscape, often at great cost. The trade war, far from achieving its stated objectives, has had unintended consequences. Supply chains have been disrupted, leading to delays and shortages in various sectors. It has disrupted global supply chains, raised prices for consumers, and fueled uncertainty in the global economy. Businesses worldwide are feeling the strain, with many facing increased costs and operational challenges. The trade war's ripple effects are felt far beyond the borders of the US and China. Countries around the world are experiencing the fallout, as global trade routes are reconfigured and economic alliances are tested. The economic conflict has become increasingly intertwined with geopolitical tensions, raising concerns about a new Cold War. Diplomatic relations between the two superpowers have soured, with each side accusing the other of economic aggression. As the trade war enters a new phase, the world watches nervously, hoping for a resolution that can avert further economic and political damage. The stakes are high, and the outcome remains uncertain, with potential ramifications for the global economy and international relations. China, in the face of US tariffs, has not remained passive. Instead, it has taken proactive measures to counteract the economic pressures and challenges posed by these tariffs. It has deftly maneuvered to mitigate the damage and emerge from the trade war in a position of strength. By implementing a series of strategic initiatives, China has aimed to not only protect its economy, but also to enhance its global trade presence. One of China's key strategies has been trade diversification. This approach involves spreading its trade activities across multiple countries and regions to reduce the risk associated with over-reliance on a single market. Recognizing its reliance on the US market, China has actively sought to reduce its dependence on American consumers. This has been a calculated move to ensure that its economy remains resilient in the face of external pressures. It has done so by forging stronger trade ties with other nations and regions. This includes negotiating new trade agreements and strengthening existing ones to create a more balanced and diversified trade portfolio. This strategic pivot has seen China deepen its engagement with its Asian neighbors, enhancing economic cooperation and trade flows within the region, cultivate relationships with European countries, which are seen as vital partners in its trade diversification strategy, and expand its economic footprint in Africa. By investing in infrastructure and development projects, China has strengthened its ties with African nations, creating new opportunities for trade and investment. Central to China's diversification strategy are two major initiatives, the Belt and Road Initiative, or BRI, and the Regional Comprehensive Economic Partnership, or RCEP. These initiatives are designed to enhance connectivity and economic integration across multiple regions. The BRI, a massive infrastructure and investment program, aims to connect China to over 60 countries across Asia, Europe, and Africa. This initiative not only facilitates trade, but also promotes economic development in participating countries. RCEP, a free trade agreement among 15 Asia-Pacific nations, including China but not the US, has created the world's largest trading bloc. This agreement simplifies trade regulations and reduces tariffs among member countries, fostering greater economic collaboration. These initiatives, alongside other bilateral agreements, have allowed China to find new markets for its goods and secure alternative sources of raw materials. This has been crucial in maintaining the stability and growth of its economy. This diversification has provided a buffer against U.S. tariffs, lessening their impact on the Chinese economy. By spreading its trade activities across a wider range of partners, China has built a more resilient and adaptable economic framework. The trade war has triggered a significant shift in global supply chains, causing ripples across various industries and economies. Faced with rising tariffs on goods produced in China, many companies, both Chinese and multinational, have opted to relocate their manufacturing operations. This strategic move is aimed at mitigating the financial impact of the tariffs and ensuring the sustainability of their business models. This exodus has seen factories shift from China to other countries in Asia and beyond, seeking to avoid the tariffs and maintain their competitive edge. Countries like Vietnam, Malaysia, and Mexico have become attractive alternatives due to their favorable economic conditions and strategic trade agreements. Countries like Vietnam, Malaysia, and Mexico have emerged as beneficiaries of this supply chain realignment. These nations have not only welcomed the influx of manufacturing, but have also invested in infrastructure to support this growth. These nations, with their lower labor costs and favorable trade agreements, have attracted significant foreign investment. The influx of capital has spurred economic growth, creating jobs and boosting local economies. They have become new hubs for manufacturing, particularly in sectors like electronics, textiles, and footwear. This diversification has allowed these countries to build more resilient economies. This relocation of production has been a double-edged sword for China. While it has helped to cushion the impact of U.S. tariffs, it has also led to job losses in some sectors and raised concerns about the hollowing out of China's manufacturing base. While it has helped to cushion the impact of U.S. tariffs, it has also led to job losses in some sectors and raised concerns about the hollowing out of China's manufacturing base. The shift has forced China to rethink its economic strategies and focus on innovation and high-tech industries. The shift in supply chains highlights the interconnected nature of the global economy and the far-reaching consequences of trade wars. It underscores the delicate balance that countries must maintain to protect their economic interests while fostering international trade. It also underscores the adaptability of businesses, which have shown a remarkable ability to adjust to changing trade landscapes. Companies have demonstrated resilience and innovation, finding new ways to thrive despite the challenges posed by tariffs and trade barriers. China has deployed another powerful tool in its arsenal to counter U.S. tariffs: currency devaluation. By allowing its currency, the yuan, to weaken against the U.S. dollar, China has effectively offset some of the impact of the tariffs. A weaker yuan makes Chinese goods cheaper for buyers in the U.S. and other countries. This price advantage helps to maintain the competitiveness of Chinese exports, even in the face of increased tariffs. China's currency maneuvers have not been without controversy. The U.S. has accused China of manipulating its currency for unfair trade advantage. The depreciation of the yuan has also raised concerns about capital flight from China and its potential impact on global financial markets. Despite these concerns, China's use of currency devaluation underscores the multifaceted nature of its response to U.S. tariffs. It demonstrates China's willingness to utilize a range of economic levers to defend its interests and maintain its economic stability. China's domestic support system is, well, quite comprehensive. It includes subsidies for farmers, price controls, and various forms of financial assistance. These measures are designed to stabilize the agricultural sector and ensure food security. Additionally, the government invests heavily in rural infrastructure, aiming to boost productivity and improve living standards in the countryside. This system, you see, plays a crucial role in maintaining the balance between urban and rural development. It's a multifaceted approach that, frankly, has significant implications for both the domestic and international markets. China's response to tariffs has been nothing short of strategic. By leveraging its advancements in technology, China has aimed to mitigate the impact of tariffs imposed by other nations. This tech-driven counteroffensive includes investing heavily in homegrown innovations and reducing reliance on foreign technology. It's a calculated move to not just survive the trade war, but to come out stronger. In the midst of rising tensions, there have been efforts to ease the strain without giving in. Diplomatic talks and negotiations have been pivotal, with both sides looking to find a middle ground. The aim is to de-escalate the situation while maintaining a firm stance on core issues. It's a delicate balance, requiring careful navigation to avoid further conflict. The escalation of tariffs and trade barriers has not come without its costs. Both economies have felt the strain, with businesses and consumers bearing the brunt. Increased prices, supply chain disruptions, and economic uncertainty have all been part of the fallout. The question remains, how much more can each side endure before seeking a resolution? The ripple effects of this trade conflict have been felt worldwide. Global markets have experienced volatility, and other nations have been caught in the crossfire. There is a growing concern that this could lead to a new kind of economic Cold War, where alliances and trade relationships are reshaped. The stakes are high, and the world watches closely, hoping for a path to stability.